Good morning, good afternoon, good evening, guys. Welcome to BABYTRADER Forex Community. So a little recap of what we did last week. So last week was our introductory class on the and we talked about Forex, which I told us Forex is an acronym for foreign exchange. What do? We trade currencies of several nations. By several nations, I mean we sell one currency asset for the other. You trade one currency against the other. You trade a weak one against the stronger one. So among the currency pairs we talked about, I think we had the Euro USD, the GBP USD, AED USD, Japanese yen, and their likes. And I told us how to use the TradingView interface, which is what we can see on my background currently. This is the TradingView interface. It's a free web page where you do all your technical analysis. And I walked us through how to use the tools and everything therein inside to use. Then we talked about market structure, a brief introduction where I told us the market is in three phases. You have the accumulation or the ranging market, where the market is price bound, it's not breaking up, it's not breaking down. It's just in a range over a period of time. Then we have the bullish market rather, where the market is making waves to the upper side, like impulsive push, gaining strength to the upper side. That's a bullish market where you look for just buying opportunities. Then we have the sell or the bearish market structure, where the market is losing strength or losing momentum. So it's going down, impulsive push, little correction, impulse correction, like that to the downside of the market. So we had these three phases and we talked about them, of which I told us we don't trade the accumulation or the ranging markets because you don't know where to break out to. So most of the time, avoid the accumulation phase. Then we have the bullish market where the market is tending towards the upside. So you look for buying opportunities here, bullish market here. Look for buying opportunities, bullish market structure there. Then we'll have the bearish market structure where you look for selling opportunities. So that was the very basics of the market structure I introduced us to last week. Then we talked about the COT report, where I told us that's where the big boys do their meetings and report where they are to put their positions in the market. And I gave us the website, which was tradingstar.com. Here's the website. Then if you go down, you see plenty of assets. So let's just do a little recap. Open tradingstar.com is a free web page. When you go down, you see several assets there. So let's work with, okay, let's check for gold. Let's see. So you come down to metals. Under gold, you see COT legacy, CCOT. You click on the COT legacy column. Click on it. This data was reported on the 23rd of last month, of which is still very valid. But I told us they update this stuff every month, every Tuesday rather. So if you go down, you see the long contracts, you see shorts, sorry, you see the non-commercial, you see commercial, you see total, you see non-reportable. So I told us we stick to the non-commercial column alone, under which you have the longs, you have the shorts. Then if you see properly now, you always work with where there is small numbers. If you check here now, we have 332,808 points to the long, then we have 66,000 points to the short. Then they added 6,000 points to the long and added 5,000 to the short. If you add everything together, you still have more long points on gold. Check the percentage below. You have 62.9% against 12.5%, telling you Gold is to go bullish in the long run. And after checking your COT, you go to your TradingView page and type gold XAUUSD. Then you look for structures that support the bullish side of the market, which you can see now gold has been very bullish. You look for buying opportunities and engage and do your stops. Then after that, we talked about the candlesticks that move the market, of which I told us we'll limit ourselves to just basically four candles. And the candles were one, the Doji, two, we had the hammer, three, we had the three candle formation, then four, the engulfing candle. And I told us these are the four candles that do first major moves. Most important moves in the market starts or originates after this candle, which I told us the first three show possible reversal. Then the last one shows strength that okay, well, the trend is confirmed. So that was that. Then I think we still went as far as doing how to size an account, where I showed us that risk management matters in this space. We are Forex traders and not gamblers. And what differentiates us from the average man out there is your ability to size your accounts and trade well, not just emotions, not just randomly. You trade well, knowing what you have to do, then you size your accounts properly. And I told us you size your account after you've done your technical analysis. Let's say for this example now, I have CAT CHF here. I've seen my sell structure, which is my impulsive push, impulse correction, impulse correction, impulse. That's the sell structure already. And if you look at it, if you look properly now, I have my three candle formation here. So I can mark that now as my point of entry. We'll get to entry criteria much later. So after you've gotten your point of entry, which is your three candle formation, after you've gotten your point of entry, you come to your sizing, forecasting size to you pick your short position to put it at your entry point, SL above. Let's say we'll target 1 to 4, the 1 to 5 good. Then you go back to that forecasting to pick your price range to measure how many pips your entry to your invalidation zone will give you. For this one, I have 5.4 pips as my SL value. Then what do? You go to my FxBook, myfxbook.com, locate calculators, FX calculators. Then you go down to position size calculator. It's a free web page, so you can do everything for free. Position size calculator. And when you go down, currency pair, we charted the card CHF. Our SL was 5.4 pips SL. So you go back. Currency pair, card CHF. So let's assume we have a 500 USD account, 500 USD. And I told you always swap with money, don't do risk. Swap with money so you know how much you want to risk per time. Unless you want to risk $10 per time. Stop loss pips, I think we had 5.4 pips as our SL, or invalidation zone 5.4. Then you click on, you don't touch this lot size here, then you click on calculate. So the actual lot size for you to use now is lot 0.15. So you pick this 0.55 and use and place trades on your MetaTrader 5. Okay, guys, so that's a quick recap of what we did last week. So if you have any questions, but there's something you want me to talk more on that I didn't do much on the previous videos, drop a comment in the comment section, then I will look into it and do the needful. And I'll still do more videos this week and upload for us. Okay, guys, so stay tuned. Subscribe to the channel, share, and keep watching. Thank you, guys. Stay put.